US-China make peace in Switzerland. For now, India and UK sign a historical trade deal, and why I have lost confidence in Nike's management yet again. This is Vinayutam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We are on episode 127 this week. Tariff talks were back on investors' minds again. I mean, it's like they never left, right? I mean, even last week when it was all about when it was something else, tariffs are always in the picture. But now they're back. They were back on investors' minds again. But this time, for a change, the sentiment was largely positive due to the developments that transpired. Was the sentiment a tad optimistic though? We'll find out shortly, but markets still ended marginally lower for the week, and that's because Fed Chair Jerome Powell and company gave some pretty hawkish comments, along with doing nothing about interest rates. So, the doing nothing about interest rates was kind of expected, but the hawkish commentary wasn't. So, markets for the week ended lower. All said and done, all three indices finished the week in the red. Dow sliding 0.2%, S&P 500 sliding 0.5%, and the tech-heavy Nasdaq slumping 0.3%. So without further ado, let me welcome you to Doctor's Weekly Snapshot and discuss the week gone by in the US markets. One that can largely be characterized as the Fed on the one hand versus tariffs on the other hand. Of course, the tariffs has become a lot more important, and the dramatic development that transpired over the weekend turbocharged the markets once again. You would have already witnessed it, experienced it last week with massive gains in all three indices because of a certain event that transpired over the weekend. I'll get to this in a bit. A little bit tease for you, but the funny bit is the most dramatic event of last week actually took place on the weekend. The one that could actually shake the markets, could resize the shape, could basically even has the potential to reshape global trade as we see it, actually took place on the weekend. So during the week, it was Fed versus tariffs, but not as much, not as dramatic as what happened in the weekend. Anyway, I'll get to that in a bit. Let's start with the Federal Reserve, which took center stage once again last week as it made the decision to hold interest rates steady. Like I said, the holding the interest rate steady was kind of very, 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 expected, anticipated, and it was very, very unsurprising. It was nothing, no big deal. Everybody knew Fed was going to hold interest rates steady. They did. Great. Powell and Co, though, cited heightened economic risks stemming from recently imposed tariffs behind their decisions to leave rates unchanged. Chair Powell emphasized a wait-and-see approach given the uncertainty surrounding the economic impact of the tariffs. Now, the central concern here is the effect of large sustained tariff increases, particularly those targeting Chinese imports, now at 145%. Scratch that. Now it's at another figure, but more on that in a bit. At the time Fed Chair Powell was speaking, it was at 145%. Powell warned that these tariffs are likely to raise inflation by increasing the cost of imported goods, slow economic growth by reducing business investment and consumer spending, and increase unemployment at companies as companies face higher costs and uncertainty about the future input prices. However, despite expectations of a slowdown, the hard data showing a clear downturn had not yet transpired or was not yet evident, according to the Fed commentary, according to Chair Powell's press conference. Labor markets are cooling, wage of growth is slowing, but inflation expectations, as measured by financial markets, remain pretty much subdued. Remember, the Fed has dual mandate. Yeah, they got to balance two things. And what is that? Number one, it's got to balance price stability, inflation. And second, it's got to ensure there's maximum employment. So you've got to balance the labor market pressures or labor market forces, essentially. So it's playing the weighing scale game where it needs to be, perfectly balanced on both ends. It's got to manage the growth without driving up inflation too much, and it's also got to, do the necessary moves so that unemployment rate doesn't shoot up. So it's a very fine, delicate act in recent years that the Fed has to do. But remember, that's the dual mandate. Chair Powell, during the press conference, keeping in line with the dual mandate, stated that the costs of waiting for more data are fairly low and stressed patience, noting that the Fed can act quickly if they want. To be honest, To be fair to the Fed, they have acted quickly whenever, I mean, when they wanted. All you got to do is go back to the COVID times, or March 2020, when the Fed really intervened in an emergency meeting. They called emergency meeting and they did it. So, should the economy fall off a cliff, there are moves within the Fed. So, that statement, the Fed can act quickly if needed, that's fairly accurate. We have recent evidence. We don't need to go 50 years to check the evidence. We already have the evidence. Now, basically, all you can, the main takeaway you can get from Fed Chair Powell's conference and commentary and all of that is basically the Fed is what I call a holding pattern. It has to balance the risk of higher inflation against the risk of rising unemployment as tariffs create new economic headwinds. Chair Powell and the Fed are committed to a data driven, patient approach, ready to adjust policy as clearer signs of economic direction emerge. Remember, the Fed has always come out, especially since 2022. One of the terms that Chair Powell has repeatedly said in pretty much most of his press conferences is this is a data driven Fed or a data dependent Fed. They've stuck to that word. They've stuck to that word, and subsequent meetings since he said the word data dependency in his press conference, they've stuck to it. And I got to give credit to the Fed. Now, whether it's the right approach or not, only time will tell. But there is no question about it that the Federal Reserve has been data dependent and have stuck to their word. At least you can trust them. There is a certain trust in the Fed again. Now, the situation remains fluid, of course, with both market participants and policymakers closely watching for further developments in trade policy and economic data. And boy, did we get one in the weekend. Again, a little bit more weight, guys. Having said that, investors still broadly anticipate rate cuts in the second half of 2025, an estimate that would have strengthened over the events of the weekend. I mean, right now, I'll get to the events of the weekend, but certainly even before the events of the weekend, people were expecting rate cuts in the second half of the year. Some say two, some say three. On average, it's 2 or 3 rate cuts was the consensus. That's the Fed. Now, the other major market mover up until the weekend, right up until the weekend, was of course the US trade policy. And one of the major developments that boosted the markets was the announcement made by President Trump on a preliminary trade agreement framework. Now, the keywords here or key phrase here is preliminary trade agreement framework. Double keyword, more important keyword is preliminary. Yeah, keep that in mind. With who? With none other than the United Kingdom, making the first such pact since the US imposed tariffs on both allies and adversaries. Since April 2nd, then subsequent pause on April 9th, this is the first major bilateral pact that has been called for preliminary. It's not fully signed yet. Key points of the framework include most UK goods will remain subject to the US's new global 10% tariff baseline, thereby indicating that the 10% tariff baseline is here to stay, whether you make a deal with US or not. Established, UK steel and aluminum will be exempt from the US's 25% tariff. UK car tariffs will be reduced from 25% to 10% for the first 100,000 vehicles exported to the US annually, and exports above the quota will obviously face the 25% rate. The UK will cut tariffs on US beef imports from 20% to 0 and will also reduce tariffs on ethanol. The UK also agreed to purchase Boeing jets and provided greater access for American farmers to the British market, including beef and ethanol. Finally, the US will allow Rolls-Royce jet engines and parts to be imported tariff-free. Preliminary trade agreement looks all good. We'll have to wait for the final details. We'll have to see if there are any changes that happen in the final details. Now, while the markets cheered post the announcements of the US-UK deal, I doubt it has actually anything to do with the deal points actually, or rather with the actual deal itself. Now, this is because the deal with the United Kingdom was probably the easiest one for the US to make, and here's why. It's because unlike most US trading partners, the UK stands out as the only one with which, I repeat, the only one with which the US runs a trade goods surplus. And the UK is the 9th largest US trading partner with total goods trade volume significantly smaller than that with Mexico, compared to Mexico, who is US's largest partner. So both nations also have deep investment ties and robust services trade. In short, the UK being the first nation to strike a deal with the US is actually no big deal. It's absolutely it was it's this is not something to so I don't think the markets cheered the fact that oh we made a deal with the UK. Fantastic. No, it was always going to happen. It's the easiest one to make. The question then becomes why was there euphoria in the markets post the announcement? It is because of shift in sentiment with respect to US trade policy. By announcing a deal with the UK, the United States, and more importantly, President Trump sent a very clear signal that at the end of the day, negotiations and trade agreements are what the Trump administration is really seeking, rather than punishing nations with whom United States has a trade deficit. I mean, yes, sure, I mean, China has been punished. You could call, 90 days later after the reciprocal tariff pause, anything could happen. But the main goal by announcing a trade deal with the United Kingdom and more to come as promised by Trump administration officials, it just goes to show that basically what they're looking for is a deal rather than punishing the adversaries, punishing allies, or punishing other nations for having a trade deficit. Having a trade deficit is a headache, yes, for Trump, sure. For President Trump, it's a headache, absolutely. But he wants to remove the headache. He wants to get rid of the headache by making a deal rather than by actually long-term punishing. And there was no bigger example to this than what happened over the weekend. And this brings me, ladies and gentlemen, to the main event. It's like they say in WWE, to the main event that happened on the weekend. Now, during the week, it was announced that Treasury Secretary Scott Bessent and Trade Representative Jameson Greer would travel to Switzerland to kickstart trade talks with China over the weekend. But absolutely no one, and I mean no one, not me, not analysts, not bigger analysts, not more experts for 50 years in the market, no one was anticipating what actually happened in Switzerland over the weekend. The US and China unexpectedly reached a significant trade agreement, temporarily de escalating a trade war that had threatened to destabilize the global economy. This deal, announced after intensive weekend negotiations in Geneva, rolls back most of the steep tariffs imposed by both countries since April of this year and sets the stage for further talks aimed at a more comprehensive resolution. More specifically, get this, this is the big one. More specifically, the US will lower its tariffs on most Chinese goods from 145% to 30%. That is not a typo. This is not a mistake. I'm saying it's 30%, 30. From a whopping 145, it comes down to 30. This 30% includes a levy related to China's alleged role in the US fentanyl crisis. You could always think, remember when initially the first trade deal, the first tariffs that were launched were 20% on Mexico, Canada, and China, right? And then there was a 10% baseline. You could think of the 30% as 20% of the fentanyl thing plus 10% baseline. You could consider that, although the more details on that were not given. This is just my math. But it does include a levy related to China's alleged role in the fentanyl crisis. China will reduce its tariffs on US goods from 125% to 10%. 10. No, not a typo. 10%. 10%. This is not a typo. It's not a mistake. I had to double, triple check the data. It is from 125% to 10%. Now, these new tariff levels will remain for 90-day period, during which both sides will continue negotiations in hopes of reaching a longer-term deal. China agreed to suspend or cancel some non-tariff retaliatory measures, potentially including easing export restrictions on critical minerals used in batteries and high-tech applications. Absolutely no one was expecting this. President Trump announced on social media that ahead of the weekend, on Friday, I believe, that he felt 80% tariffs felt right. But for the final rate to come down to 30%, albeit for 90 days, was an absolute game changer, in my opinion. And at the time of preparing for the show, the stocks futures were surging. In fact, on Monday, they were absolutely surged away. All three indices ended up very much well in the green. Even NASDAQ 4%, S&P 4%. It was massive. It was a complete green across the board. I think the only sectors sort of that were losing were the ones that were gaining when pandemonium was striking. So Netflix had a surprise drop because Netflix was considered to be more defensive play. Then you had gold that got absolutely crushed because obviously gold was a safe haven. What safe haven? Apparently, sentiment clearly shifted. So so it was an absolute it was a bull rally of epic proportions in the US markets and in the global markets as well. Now, the deal averts for now the threat of severe price increases and product shortages for the US retailers and small businesses dependent on Chinese imports. For China, it reduces the risk of mass job losses in export industries and the potential for further globe trade isolation. Just last week, we got data that showed China's exports to the US dropped sharply in April 2025, falling 21% over year as a direct result of steep tariffs imposed by the Trump administration. As such, this temporary relief is not just a win-win, but more like a home run for those baseball aficionados. Don't get me wrong, still issues that remain unresolved. The agreement is a 90-day pause, not a permanent settlement. The underlying issues, trade imbalances, industrial policy, illicit drug flows still need to be sorted out. And even after reductions, baseline tariffs remain higher than the pre-2025 levels, and a 10% baseline US tariff on Chinese goods is likely to persist, similar to what we saw when reciprocal tariffs were paused. Remember, the UK got 10%, so China minimum is going to get 10% baseline tariff. That's a given. That much is certain for sure. Absolutely certain. And I continue to believe that volatility will still be the name of the game, given that talks can break down at any point, especially since tariffs are unlikely to return to pre-Trump 2.0 levels. Having said that, what the weekend did bring was a sense of stability when it comes to the tariff negotiations. The weekend clearly established Treasury Secretary Scott Bessent as the leading figure in the US trade policy, in contrast to President Trump's more abrupt tariff strategies. Secretary Bessent is seen as pursuing deeper economic reforms, aiming to encourage China from an export-driven economy to one focused on domestic consumption. It is this sense of stability, one that it is this sense of stability that has seen the U.S. trade policy move towards a more strategic, reform-oriented approach that seems to have also caused a lot of positive market sentiment. While we still don't know how the US-China saga would conclude, the weekend certainly proved it is very much possible that the end game may not be as worse as expected. Switzerland has widely been recognized as a peacemaker due to its long-standing tradition of neutrality and its active involvement in international diplomacy and peace efforts. This weekend certainly boosted that image of Switzerland, even though the country itself had nothing to do with it, with what happened between US and China. Maybe it's the air in Switzerland. Whatever it is, Switzerland could very well be the location that becomes the catalyst for US market rally as seeds were sowed that could reshape global trade for good. Now, whether that's a positive or negative, only time will tell. And with that, I'm going to take you straight to the next segment. The doctor goes home. Investors can certainly enjoy some Swiss cheese, right? Okay, enough about Switzerland. Let's get to India now. Welcome to the Doctor Goes Home segment. Before I start the segment, I just want to say one thing, guys, and I'm going to be a little serious here. Well, this is not a political show. Doesn't mean that I can't share my emotions, right? And today I just want to say that I'm absolutely proud of our armed forces who have done a remarkable job in ensuring that terrorism has no place in this world. You guys are the true heroes as you put your lives at stake in protecting the citizens so that citizens can sleep in peace at night. I salute you for your commitment and for your service. 1 billion of us can sleep in peace knowing that the country is well and truly safe in your hands. Thank you and Jai Hind. And I sincerely hope that no more innocent lives are lost. Right. I had to say it, with the events that have transpired over the weekend, I had to say it. Now, it's not a political show, obviously, but doesn't mean that, you got to stand behind the men in brave, right? As we call it. So, right, back to the segment now. Indian investors had a lot on their mind, especially with geopolitical tensions. I don't need to tell you guys about this taking center stage this week. Overall, I have to say, though, that just like our armed forces, the markets were also incredibly resilient as they navigated what was a pretty tricky environment. The resilience could also be due to the fact that we also got a historic trade deal with the United Kingdom. The UK has been on a roll, yeah, the US, India, everything. One that has been in the works for a few years now. An India-UK free trade agreement, remember it's not bilateral, it's free trade agreement, is one that is highly beneficial for the Indian economy, which probably explains why there was buying despite in the markets despite geopolitical tensions. So let me start first with the key highlights of the India-UK FTA before I talk about which sectors stand to gain the most. Now, the free trade agreement aims to significantly enhance bilateral trade between India and the United Kingdom with a goal to double trade to $120 billion by 2030. It offers comprehensive market access for Indian goods and services in the United Kingdom and reciprocal benefits for British firms in India. India will eliminate import duties on about 99% of the tariff lines, covering nearly 100% of trade value, a major gain for Indian exporters. In return, the United Kingdom has agreed to reduce tariffs on approximately 90% of Indian tariff lines, with many tariff cuts phased over time. The UK government projects the deal will add £4.8 billion annually to the UK GDP and increase wages by £2.2 billion in the long term. Bilateral trade between the two nations is expected to increase by £25.5 billion annually. The deal is described as the best trade agreement the United Kingdom has ever secured with India and the most economically significant bilateral trade deal since Brexit. Remember Brexit? Nearly 10 years. Next year is 10-year anniversary, a decade. Not saying good or bad. How does the free trade agreement change the investing landscape, you ask? Well, for starters, once the agreement goes into effect, the Indian industrial goods such as leather, footwear, textiles, gems and jewelry, base metals, furniture, sports goods, auto components, chemicals, and machinery will enter the United Kingdom duty-free immediately. So these are the sectors that investors should obviously look at it if you were to play the UK FTA trade. At the same time, sensitive agricultural products like dairy, apples, cheese, oats, and oils are excluded from the duty benefits to protect the respective domestic sectors. Some sensitive goods like plastics, diamonds, smartphones, and optical fibers are also excluded or subject to gradual tariff reductions. Now, personally, I find the Indian auto space to be more competitive, to get more competitive once the free trade agreement falls into place. And this is because India is expected to reduce tariffs on imported automobiles from the UK from over 100% to just 10%. Having said that, ironically, one of the biggest beneficiaries would actually be our own Indian automaker, Tamo, Tata Motors, whose Jaguar Land Rover subsidiary manufactures in the UK. While the company has yet to comment on it, once the agreement bears fruit, then Tamo, without a doubt, stands to gain a lot. And boy, does it need this boost desperately, given its recent struggles domestically, both in conventional ICE and the EV segments. In addition to goods, the services sector is also expected to receive a boost. The United Kingdom has agreed to a regime facilitating temporary entry and stay for various categories of Indian professionals, including business visitors, intra-corporate transferees, contractual service suppliers, independent professionals such as yoga instructors, musicians and chefs, and of course, investors. The agreement also facilitates new opportunities for diversifying services exports, including digitally delivered services, and eases the mobility of professionals between the two countries, which can boost India's services exports to the UK across multiple sectors. IT companies, as a result, are expected to receive a huge boost, in my opinion. A significant social security pact called the Double Contributions Convention exempts Indian workers temporarily in the UK and their employers from paying UK social security contributions for 3 years, expected to benefit over 60,000 IT sector employees and save around 4,000 crores. Further states my point that the IT sector stands to benefit a lot. Bottom line, at a time when global trade tensions are elevating along with geopolitical risks, the UK-India Free Trade Agreement is a huge boost for both countries. Having said that, don't expect the impact from the trade agreement anytime soon. The stocks may have rallied, but that's driven by sentiment, not by ground reality. This is because the legal text of the agreement is undergoing finalization. That's expected to take about 3 months. After all this legal scrubbing, the agreement will be signed, followed by the approval from the Union Cabinet in India and the UK Parliament, and a process that is expected to take around a year. The free trade agreement will enter into force on a mutually agreed date once all governmental procedures are completed. So the sectors that stand to benefit will have to wait a little more, but obviously from a long-term perspective, you can start to look at these sectors because again, it's a long-term play, right? Free trade agreement tend to be a long-term play. But it does open up avenues for India to strike similar deals with other nations. The EU is currently in talks with India to create an FTA or a bilateral trade agreement of its own. And then there's the big one, the United States. Now that a massive tariff pause has been instituted on China for 90 days, US's focus will shift on striking deals with other nations. And India, remember, is at the front of the queue. The goal announced by both governments was to make significant strides surrounding a bilateral trade agreement by fall, so August, September. As such, I do expect things to speed up now that the China situation has been put on hold. I don't want to say the word resolved, it has been put on hold. All in all, it looks like significant strides are being made by India in its quest to become a global hub. And investors are paying attention, as evidenced by the reversal in FII trend from net sellers to net buyers and a record buying by the domestic institutional investors. Indian equities are in a buyer's market phase once more, and based on the developments that are transpiring or have transpired, momentum is here to stay. On that note, let's head to the final segment, the Doctor Dissects. Now, this week on Doctor Dissect segment, another retail giant goes under the microscope. But unlike last week, Lululemon, this is one that I've not particularly liked over the years. Management missteps, common, a little bit of management arrogance, slowing sales, higher inventory. There's been a lot of problems over the years. Not really liked. I was a buyer once, but then I've sold my position a long time ago. The company I'm talking about, ladies and gentlemen, is the retail giant Nike, ticker symbol NKE. Now, Nike announced its third quarter results last week, and if one carefully listened to Nike's Q3 earnings call, then it becomes very clear that the management really tried their best to demonstrate a lot of optimism about the company's future. New CEO Elliot Hill, about 6 months into the job, talked about how, after studying the current state of the company, he and his team have outlined a new turnaround strategy dubbed Win Now. The strategy would prioritize 5 core areas: running, basketball, football, training, and sportswear, and across 3 countries: US, China, and the UK in general, and 5 cities: New York, LA, London, Beijing, and Shanghai in particular. Now, the Win Now strategy will also focus on a complete product refresh by focusing on new product launches in order to offset the continuous decline seen in the company's flagship products such as the Air Force One and the Jordan 1. Finally, the strategy also focuses on a clear goal of rebuilding relationships with the company's wholesale partners and refining its marketplace presence, especially in China, in order to improve customer engagement. Now, the most recent quarter, the third quarter of Nike results released last month, came in actually much better than expected with a beat on both the top and bottom lines. But all key metrics showed significant declines. I am particularly concerned about the gross margins, which were down 330 basis points. That's 3.3%. And diluted EPS, which was down a whopping 30% year over year. Moreover, while inventories were down 2% year over year, they still came in at $7.5 billion, which suggests that Nike has a lot of work ahead to clear out their old merchandise before they can even consider scaling up their new products. There was some indication that this might be the case during the Q3 earnings call when management announced that the production of Pegasus Premium is only expected to scale up by the fall of 2025, and new additions to their Vomero franchise are only expected to arrive at some time during the next fiscal year. Finally, the pain from China continued as revenues declined 15% year over year on a constant currency basis, and EBIT, earnings before interest and tax, in the region declined by a whopping 42% year over year. Despite these dismal figures and despite issuing softer than expected guidance, the management during the earnings call was buzzing with optimism and reiterated their confidence in the success of the Win Now strategy. Now, this is not the first time, I told you at the start of the segment, it's not the first time that Nike management has demonstrated irrational optimism. And it is unfortunate that despite being in a harsher macro environment today, this undue optimism simply doesn't seem to subside. Investors, in my opinion, shouldn't fall for this optimism, personally speaking, even if the reciprocal tariffs have been paused and tariffs on China have been cut dramatically, albeit for 90 days. The tariffs still exist, remember? It's just that they aren't as horrible as the ones that were announced back on April 2nd. 30% is still high, guys. It's not low. These tariffs have, according to me, made Nike's turnaround strategy likely to be what I call dead on arrival. Now, there are multiple reasons behind my thesis, the dead on arrival thesis. Firstly, the company's guidance for Q4 did not take into account the impact of any tariffs, which have come in much harsher than expected. Q4 gross margins, for instance, are expected to be down 400 to 500 basis points. It's 4 to 5% as a result of the transition to the Win Now strategy. The gross margins guidance only factored in the initial tariffs that were imposed on China and Mexico. Since then, the tariffs on China have been bumped up from 20 to 30%. And while they were subsequently, while they were subsequently increased to 145%, and then obviously bring down to 30% of the weekend, they're still higher than 20%. To make matters worse, approximately 80% of the Nike's imports to the US comes from Vietnam. Another 6% of Nike's imports comes from Indonesia. While these countries were initially hit with very high tariffs before President Trump paused them, they are still subject to the 10% baseline tariffs. Now, while only about 7% of Nike's imports to the US come from China, the new 30% tariffs make it a very costly affair, albeit they've come down from 145%. Yes, I get the argument of the 145%, but 30% is still high, guys. It is therefore absolutely not surprising to me that the company tanked 14.5% post the reciprocal tariff announcements. Yes, they made a comeback, but that's a sentiment-driven rally. Consumer discretionary had one of their best days yesterday. They surged 5%. Lulu was up nearly 10%. Nike was up again 7%. All in all, fantastic grade. Nothing to do with fundamentals. It is a pure, it is an absolute pure sentiment-driven rally. Okay, so I'm not saying that Nike's management should have accurately predicted the extent of the Trump administration's reciprocal tariffs. Absolutely not. I'm also not, nobody anticipated that they would come in harsher than expected, especially based on the signals the White House officials were sending in the days prior to the announcement. But to proclaim that the Win Now strategy's success is a foregone conclusion when there was also a possibility that the macro environment would be getting far worse should not offer any reassurance whatsoever to investors. Moreover, the demand creation expense for the latest quarter was up 8% year over year, which makes the level of confidence the management has placed on this strategy even more farcical. Nike wants to win now. However, to the extent of reciprocal tariffs in the company's major import locations should make the investors wonder whether Nike could win ever. Let's talk about valuation now. I'm getting my notebook ready. And that can only mean one thing. Notebook and pen ready can only mean one thing. We're looking at Nike's valuation. All right, got everything ready. Now, the company now expects Q4 revenues to be down mid-teens range, albeit at the low end, according to them, with the macroeconomic environment at its worst in a while. And for consumer discretionary names, I've assumed Q4 revenues to decline 16% year over year, higher than the management's own guidance. This would result in projected Q4 revenues to be $10.59 billion. Okay. Projected Q4 revenues, $10.59 billion. Okay. Now, the company expects gross margins in fourth quarter to decline 400 to 500 basis points. The guidance doesn't take into account the impact of the tariffs, the additional tariffs that were eventually placed. And as such, I've assumed gross margins to decline by 500 basis points, the higher end of 5%, which would result in projected gross margins of 39.7% for Q4 and subsequently Q4 gross profits would be $4.2 billion. $4.2 billion would be the Q4 gross profits. Now, the company expects Q4 SG&A expenses to be up low to mid single digits. I've assumed a 2% increase, resulting in Q4 SG&A expenses, Q4 SG&A expenses of 3.78 billion. Okay, Q4 SG&A expenses of $3.78 billion. Other income and expenses are expected to be between 45 to 55 million. I've assumed Q4 other expenses to be 55 million. Q4 other expenses to be 55 million. Combining all these figures, you get a Q4 net income of after taxes of $0.475 billion. At 1.481 billion shares outstanding, Q4 diluted EPS is projected to come in at 0.32, and that means FY25 diluted EPS would be $2.34. Okay, FY diluted EPS would be projected at $2.34. All right. Now, according to LSEG data, formerly known as Refinitiv, the company currently trades at a forward price to earnings of 26.9 times, making it the most expensive stock among its peers. Nike is certainly a leader for now. Nobody's disputing it, but faces significantly more challenges in the current climate compared to some of its other peers, such as Lululemon. For instance, Lulu's China business is doing remarkably well compared to Nike. And while both companies have exposure to countries like Vietnam, the fact that Lulu's turnaround story is at a more advanced level compared to Nike, which has barely got started, suggests that it doesn't deserve to trade at current multiples. Last week, when I did talk to you about Lulu, I put a forward price to earnings of 22.8 on the company. Nike's trailing price to earnings stands at 17.2. I find this to be a much more reasonable estimate. So I've assumed forward PE of 17.2x. Forward PE of 17.2x. Nike currently trades at a forward PEG ratio of 11.23 according to Seeking Alpha, which makes it significantly overvalued relative to the industry median, that's 1.26, and relative to its own five-year historical average of 3.36. At a historical five-year forward PEG of 3.36, EPS growth would be 5.12%, and that's what I've assumed. So FY26 EPS, projected EPS, would come in at $2.46. By 26, EPS would be $2.46. So you have 17.2, multiply that by 2.46, and you get a price target of 43. Okay, so you get a price target of 43, which suggests that the stock is currently overvalued by nearly 30% at current levels. To make matters far, far worse, the company's momentum is significantly broken, as seen by the C- grade on the Seeking Alpha momentum scale. Combining all of this, I'm definitely downgrading Nike from hold to sell. Okay, I don't care about the sentiment-driven rally yesterday. I don't care about all the tariff-driven rally that we got. Nike fundamentally, I'm downgrading hold to sell, upgraded price target of $43. Now, of course, when I make a sell case, risk factor should be considered as well, because risk factor to bear case, right? So risk factor to my bear case is simple. The impact of tariffs would turn out to be relatively lower compared to what is currently being expected. In other words, even if it's 30%, could come down to 10%. Of course, Nike would surge. To an extent, like I said, this has already happened. The reciprocal tariffs were paused. Tariffs in China have come down from 145 to 30%. Anything lower would be more positive and could see the company getting a significant boost to its margins. The other risk factor is that the company can clear its existing inventory at lower markdowns than current expectations. Once again, this would boost margins. This would boost margins and subsequently the company's bottom line. Look, Nike has undergone quite a transformation since I last talked about the company. CEO John Donohue is no longer at the helm. There is a real sense of emergency from the current management about undertaking a long overdue product refresh. The Q3 earnings call was one where the new CEO, Elliot Hill, was expressing a lot of confidence in the company's latest turnaround strategy called Win Now. While the strategy does sound promising, there is a long way to go before the company can get back to the growth trajectory, in my opinion. The existing products continue to be sold at a discount, thereby affecting the company's margins. And the $57.5 billion and the $7.5 billion in inventory suggests that there is a long way to go before they can be cleared. While the new products have been well received, they are not likely to change the company's trajectory in the near term. And then there is the reciprocal tariffs, the impact of which the management simply hasn't considered in the guidance. The tariffs come in far worse than expected. Obviously, they've been paused, but there's still a 10% baseline tariffs, could very well go back up post the 90-day pause, as a result of which the company's growth is likely to be adversely affected. From a valuation standpoint, the stock continues to be overvalued at current levels. What is so surprising is the hyper optimism that the management continues to exude despite all the headwinds that I've talked to you about today. The last time such levels of misplaced optimism were projected, the CEO ended up losing his job. Existing investors must certainly have a sense of deja vu, especially after the latest earnings call. That's all the time I have for you this week. My God, time really flew. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on the stockdoctorpodcast@gmail.com. By the way, guys, in a few hours from now, just after the episode will be published, the CPI data comes into play. So don't forget, the US CPI data will be released a few hours from now. So do do pay attention to that. We'll discuss about that in the next week's episode. Thank you once again for listening. See you next week. Until then, stay safe, enjoy the rally, and make some money.